Welcome to The Explainer. Today, we're unpacking Oracle's dramatic evolution. For decades, you and I knew them as a legacy on-premise database vendor, right? But right now, they're transforming into a crucial AI cloud infrastructure powerhouse. Let's cut through the noise and see exactly what's happening beneath the hood of this tech titan. But we've got to ask right up front to set the stakes here. Is this massive transition making Oracle the next undisputed AI giant alongside Microsoft and Amazon? Or are they walking straight into a massive, inescapable debt trap? It's a debate that's literally tearing Wall Street apart right now, and the numbers we're about to look at are absolutely staggering. To give you a clear, objective analysis, we're going to dissect both the bull and bear cases. We'll hit their AI cloud transformation, the massive RPO boom, their competitive tech moat, the bear case of debt risks, and finally, wrap up with valuation and our final verdict. All right, let's jump straight into Section 1, the AI cloud transformation, from legacy to hyperscaler. So we're seeing a really stark contrast between two eras of Oracle. Think about the slow-growing, on-premise software company of the past, just relying on standard license renewals. Now, compare that to the subscription-driven AI hyperscaler of the future. The source data shows us that their revenue structure has successfully anchored itself into a recurring, cloud-first model. This isn't just some minor pivot. It's a fundamental rewiring of the company's DNA under leaders like Sofrakits and Larry Ellison, officially putting them in the ring as the fourth hyperscaler for AI infrastructure. Just look at the numbers from their fiscal year 26 results. Their cloud infrastructure segment, infrastructure as a service, surged an incredible 77% year over year. And if you zoom in on just the fourth quarter, you're looking at a 93% explosion in growth, hitting $5.8 billion. They're actually outpacing the infrastructure growth rates of AWS and Azure, which proves that a massive chunk of global AI workloads is pouring directly into Oracle's data centers. Moving right along to Section 2, the massive RPO boom securing future revenue. The crucial question now is how all this current hypergrowth translates into guaranteed future revenue. Because, in the cloud business, tomorrow's promised cash matters just as much as today's revenue. So let's quickly define a super important financial metric, RPO, or remaining performance obligations. Essentially, this is the total value of legally signed contracts that haven't been recognized as revenue quite yet. It's the ultimate leading indicator of demand. Okay, prepare to have your jaw drop. Oracle's RPO has ballooned by 363% year over year to a staggering $638 billion. Just to put that into perspective, that backlog is roughly 9.5 times their total annual revenue for fiscal year 26. That is a number so huge it completely changes how we analyze and value the company. But here's the truly fascinating part. This massive backlog, it's not from your normal, everyday software sales. It's heavily driven by AI companies making massive prepayments just to secure scarce GPU capacity. Even more interesting, it includes something called Bring Your Own Hardware, or BYOH. Customers are literally buying their own hardware to the tune of $75 billion and bringing it into Oracle's data centers. That shows you exactly how desperate the top AI firms are to secure stable computing environments. Which brings us to Section 3, Oracle's competitive tech moat. This is the bull case. Why are companies like OpenAI and xAI choosing Oracle when AWS and Google are right there? Well, it all starts with bare metal computing. Most major cloud providers use virtual machines, right? They put software layers between the user and the server so multiple people can share it. But Oracle built their infrastructure differently, giving customers direct access to the physical servers without any virtualized middlemen. By doing this, Oracle eliminates what's known in the industry as the hypervisor tax. Our sources note that virtualization can actually spike server communication latency by up to 260%. By stripping that away, Oracle prevents computing waste and latency drags. When you're training massive, billion-parameter AI models, that absolute uninterrupted efficiency is incredibly critical. It lets them string together tens of thousands of GPUs in their Zettascale 10 superclusters with virtually zero latency. Pretty amazing, right? Add to that their brilliant Trojan horse multicloud strategy. Historically, cloud providers built walled gardens just to trap you in their ecosystem. Well, Oracle changed the game. They're literally embedding their high-margin Exadata databases directly inside rival data centers. We're talking database at Azure, database at AWS, and AI database at Google Cloud. It essentially means rival sales teams are basically selling Oracle's database for them. In fact, it caused their multi-cloud database revenue to explode by 531% in a single quarter. Furthermore, the quiet foundation supporting this whole AI expansion is their traditional SaaS lock-in. Their back-office software, things like Fusion ERP, NetSuite, and Oracle Health, provides immense switching costs. Think about it. You can't just rip out an enterprise's entire HR or supply chain system without completely crippling the company. That locks in enterprise customers and generates the steady, reliable cash flow they need to fund these ambitious AI infrastructure plans. Now, let's flip the coin. Section 4, the bear case, debt risks and the cost of scaling. Because growth at this breakneck scale definitely isn't free. We need to transition our narrative and examine the severe financial risks that are currently threatening their valuation. As one financial analyst perfectly phrased it, the aggressive scaling required to compete in AI is absolutely devouring Oracle's cash reserves. Building physical infrastructure globally is a brutally expensive game. This massive spending spree, aimed at building out 1.2 gigawatts of new data centers to meet that wild AI demand, has resulted in a terrifying negative $23.7 billion free cash flow for the fiscal year. Their total capital expenditure hit over $55 billion, vastly outpacing the cash they actually bring in from their normal operations. So, to fund this unprecedented infrastructure build, Oracle has racked up roughly $160 billion in total debt. That pushes their debt-to-equity ratio past an alarming 344%. It's gotten so high that S&P Global Ratings actually downgraded their credit outlook to negative. They warned that Oracle's adjusted debt-to-EBITDA ratio is dangerously close to crossing the threshold that would strip them of their investment-grade rating entirely. And despite spending capital like an absolute giant, the harsh reality is that Oracle remains a niche hyperscaler. They currently hold just 3 to 4% of the global cloud market share, while the big three, AWS, Azure, and Google, control roughly 68% combined. And those big three, they're spending over $260 billion collectively to maintain that lead. So it is a very crowded, very expensive battlefield for Oracle. Because they're nearing their absolute debt limit, management has to find cash somewhere else. Their solution? The dilution dilemma. They're planning a massive $20 billion at-the-market, or ATM, stock issuance. This means they're going to sell new shares directly into the market, which analysts point out will instantly dilute existing shareholders' equity by over 3%. It's a heavy overhang on the stock price right now, for sure. Let's bring it all together in Section 5, Valuation and Final Verdict. So, when you consider both the massive technical moats and the terrifying debt and dilution risks, what does this actually mean for the stock's value moving forward? Well, right now, Oracle is trading at a really high premium valuation. Their trailing PE ratio is sitting somewhere between 35 and 41.5 times earnings, which is way above their historical average of 28.5. The market is pricing them this highly because investors are heavily banking on Oracle's roadmap to eventually grow their cloud revenue to $144 billion annually. The market sees that $638 billion backlog and is absolutely willing to pay up for it today. Now, we won't tell you what to buy or sell, that's not our job here, but to determine if Oracle can actually pull this massive turnaround off, our sources highlight 2 exact KPIs you need to watch during the next earnings call. First, monitor the gross margin on their new AI capacity to see if all this massive CapEx is actually translating into profitable revenue. And second, track that ATM stock dilution rate to see how painfully this infrastructure build is impacting current shareholders. Ultimately, as you analyze this stock, you have to decide, is the promise of becoming the definitive high-performance infrastructure for the AI revolution worth the immediate pain of severe financial debt and shareholder dilution? It's a high-stakes gamble, but one that is absolutely fascinating to watch unfold. Thanks for joining me on this explainer. Keep your eyes on those margins, and as always, stay curious.